Hello.
Hey, Arn.
Hi. Okay, we can hear each other. Yeah.
Excellent.
So how you doing?
Doing good, thanks.
Yeah, so glad we could meet up. So where are you located?
Sutherland, Oregon.
Okay. All right. All right. Well, tell me what you do and how can I help? Yeah.
hmm sell residential real estate. I take that money and then invest it into limited partner deals.
Okay.
I've been doing that since 2019. Started with Grant Cardone, studied apartments, found the Sumrock Group, joined them, and then also the Multifamily Investor Nation, just kind of their Facebook group,
Okay.
and that's how I found you. Yeah.
Yeah. Well, good. So have you done any deals on the active side?
None on the active side.
So is that something you're interested in?
It is, yeah.
Okay. Okay. Because on some of your emails, it seems like you raise capital or you help people raise capital. Am I confused or?
No, just all my own personal, just as
Okay.
a straight limited partner.
Okay. Okay. Great. Well, that's great. So, how many deals have you invested in?
9 total. One of them has gone full cycle. That was in Simpsonville, South Carolina, with Park Capital. Bill Zaylor was the main guy.
We were in the same deal.
No kidding. Wow.
Yeah, yeah, yeah. Because I live in Greenville, South
Wow.
Carolina, and an investor buddy friend of mine, Ben Jones, who lives in Anderson,
What a
turned me
coincidence.
on to that deal. And I probably have about 8 or 9 LP deals too. And that's the first one that went full cycle. And yeah, that one knocked it out of the park.
For sure.
Uh, some of it was just the time they bought, and the Greenville market is off the hook.
Yeah.
Um, so then they turned right around and then they bought another building either in Malden or Simpsonville for maybe about the same price they sold the Fairview deal per door. If I seem to remember, it was about 180, 190.
Mhm.
And I didn't reinvest in that deal, not because they didn't do anything bad. It's just I need to kind of preserve my capital for my GP deals. And so I think it'll be hard for me to invest as an LP in any other deals. And actually, I've kind of come to the conclusion I don't want to even raise capital for other people's deals because uh, I'm
Like as a
in
co-sponsor.
as a
Yeah.
co-sponsor, because I'm in one or two where I'm not kind of the lead guy,
Yeah.
and it's like pissing in the wind
hmm
because I'm making suggestions that 6 to 12 months later prove they should have listened to my suggestions, and
Yeah.
they didn't. And so I just don't want to put my investor capital into deals. Well, I guess there may be some operators that I'll raise for, but I'm going to be much more selective than I have been in the past.
Yeah, and it seemed like your splits towards your LPs were really favorable as well. Oh, that's great.
Yeah,
Yeah.
yeah, and well, that's interesting because um, even though I've been in real estate a long time, since 1978, I'm relatively new to multifamily. And realistically, the first deal I closed as a lead sponsor was May of 2021.
Mhm.
And so my local partner here, Brian, who kind of handles the property management, the asset management, the project management, I've been after him for about a year to join me because the operational aspects aren't necessarily my strength. My strength, I think, is more trying to find these deals, bringing the team together, communicating with investors. But anyway, finally, I was able to convince him to come on board. And now we own like over 400 units in Greenville, scattered over 4 or 5 deals. And so to circle back to your original question, on our first deal, it was 2.8 million. We had a raise of about $1.5 million. I had been educating myself, but I had never done any, and we weren't really clear on what the appetite would be for our investors. So we started with a relatively favorable structure to the investors, and it's okay because most of them on the original deal have now reinvested with us on our subsequent deals. So over time, we may want to bump that percentage up a little bit, though I can tell
Sure,
you
they're not complaining, yeah.
well, and yeah, maybe, the split's important, but really it's more the overall market
Like that Simpsonville deal. I mean, that was 70-30 split.
yeah,
And
it would have been a winner at 60-40, it would have been a winner at 80-20.
yeah.
We're running some numbers on a deal now, and we're going to try to get to 80-20. But the way we try to do it is what will appeal to our investors, what kind of returns, and, because we kind of underwrite the property 100% first, and we see what we got, and then we try to figure out, okay, how can we structure it to give the LPs the returns they want, and we adjust. But so yeah, we're happy with them. Greenville's a great market. I've been here 8 years, and I'm not one who's going to fly all over the country looking for property. I have no interest in that. And so Greenville focused, but I will go up into North Carolina, and I am evaluating some other markets in South Carolina. But honestly, my competitive advantage is here in Greenville. My partner, Brian, lives in Greenville.
Is it Brian Taylor or no?
No. So Brian Taylor works with a friend, Mario Brown and Brian Albers. They're under the Affordable Upstate. So Mario's a good buddy. I know Brian Albers. I know of Brian Taylor and maybe spoke to him a few times.
Okay.
Yeah. So that's it. And I was a residential broker like yourself for many years. So I applaud you making those commissions and plowing it into investment. I went to work for my dad, and he basically told me early on, the brokerage would generate the income, but to create wealth or financial security or financial freedom, you'd need to invest. And so that's what I kind of did. And you're obviously on that path, so that's good.
Yeah, I worked for Keller Williams for 1.5 years, and then my dad has his brokerage license, so I transferred over and work under his license now. So,
and do you primarily do residential on the brokerage?
Yep.
Okay. And what town is it in again?
It's Sutherland, Oregon, 8,260 people.
Oh my God! So, so are there enough houses for you to sell?
Yeah. I do all right. Yeah.
Okay.
Got 2 double escrows and under contract right now.
So what's kind of the average price there?
450 or so. So I mean, the prices are still good.
So is this kind of a place where Californians move to when they want to get out of the rat race, and they bring the money, and the houses are 1/4 the price, and they do okay.
One of those sales is local, one's from California.
Okay.
It's beautiful here. I mean, there's a pond, like big pond, right, like walking distance, and mountains and it's green, and the coast is like an hour and a half away, and the river's 15 minutes away. So it's
What's the river? What's the name of the river?
North Umpqua.
Okay. So do you ski too?
I used to when I was younger. There's a few locations. Central Oregon's more like Bend area is good for skiing.
Okay.
There's like Willamette Pass that's north of me, like an hour, 2 hours probably.
Okay. All right.
Yeah.
Okay. Yeah. That
I
because
saw the
that,
X Games. I saw the X Games were on, so
really
watched those for a
okay.
bit. Yeah.
Yeah. So that's what I used to have a place in Truckee up in North Tahoe.
Yeah, I know where that is.
Really skiing is one of the things I miss most about now being in California. We love Greenville. We miss our friends. But in terms of day-to-day life, the only thing we've really given up is kind of skiing. I'm going out to the Best Ever Conference in March, and that's in Salt Lake. And I was toying with the idea of taking a few days skiing, but I just decided to fly in and fly out and kind of be done. Yeah.
Yeah.
Yeah. Yeah. So do you have any specific questions for me? So I guess one question I have would be, why did you decide to go the passive route as opposed to just starting to buy your own little rental houses and doing that?
Barrier to entry. Also, I have access to big deals. Locally, there's not really much deals, and then there's rent control in Oregon.
Oh my goodness, I didn't know that.
Yeah, you can't raise it 7% per year, and so a lot of these deals that are selling in Oregon are still at like 3.5 caps is what they show because they haven't caught up with what the regular rents are nationwide. So Texas is kind of the main one, access to there, and then but I'd like to. I mean, there's many benefits to doing it as the lead sponsor.
Yeah. So who have you invested with in Texas? Ashcroft, and who else have you invested, or have you invested with them, or who have you invested with?
Not Ashcroft. Okay. So Kenny Wolf is, I've got a few deals with him. He's based in Plano. I just invested in this Arkansas deal, which is, I guess, out of Texas. But let's see, Jade Lay. That's the Pinnacle Heights, Tahid. And then let's see, there's a Houston deal. That's a 202 unit. That's with Tudor Francu, relatively new sponsor in the Sumrock group. Another one in Longview, Texas. That's with Kenny Wolf. I have to go through them, but yeah.
So you entered the Sumrock coaching, and that was just to maybe get exposure to sponsors, or just what's the long-term game plan?
Yeah, it was getting started really. So out of college, I found Grant Cardone, watched all his videos, and his message is like, you have to go big and basically skip the single family stuff. And so that's what I focused my kind of studying on. Found Michael Becker, Old Capital Real Estate podcast.
Love Michael Becker. I'd invest with him.
I would too. I think he's
SBI.
Yeah. Mm-hmm. But that just kind of led me to that group, and then there was the opportunity there.
Okay. Yeah. So what do you look for in an investment?
Downside first. So for instance, on that last deal in Arkansas, it was HUD loan. And so there's 40-year term, 38 years left on it. And it was 3.49% interest rate. And it's it's an A-class building.
Interesting.
But I mean,
is that up in the northwest part of the state?
Yeah. Mm-hmm.
What's the town?
Rogers, Arkansas.
Okay, because I've heard good things about the northwest part of the state.
Yeah.
It because my dad taught me, key to real estate is just get long-term fixed rate debt. And that kind of went out of vogue the last couple years, but it only went out of vogue because rates went to historic levels. And I always ask people, what does historic mean? Historic, historic doesn't mean that's what you can expect, right? Or that's typical. That means it's very unusual. So all the deals I've done except one have fixed rate debt. So I'm a strong proponent on that. Right now, it's hard finding anything that makes sense. I mean, basically, you're looking maybe 6.5% for debt right now. I mean, maybe if you had an agency deal, you could get to low fives, which I don't think is too bad. But the prices haven't just adjusted enough yet.
Yeah, you got to put a lot down.
Yeah, and I don't even mind putting a lot down. I mean, that again goes back to security. And the other thing I always like to do, depending on the deal size, I like to have a couple $100,000 in the bank that I don't need, that I kind of have no plans for. It's not like that's part of the CapEx budget. It's I want the CapEx budget plus a couple $100,000. And, I've had investors ask me like, well, why do we need so much cash? Doesn't it reduce returns? And yes, it may take, if you have a couple hundred sitting there, it might reduce your IRR from 15 to 14, but in my mind, knowing that money's there is worth the 1%. So that's how I kind of approach it. I haven't taken any deals full cycle, but basically we've paid our pref payment on time in the amount we projected on every deal we've done. So we try to go in and, probably undersell the deal a little bit. So we can kind of hit those metrics and the investors feel secure.
Yeah.
Yeah.
I agree. I mean, that's my number one criteria.
Okay. Yeah. Well,
it's
tell
like,
me more. Yeah.
I was reading a book. It was actually Warren Buffett's documentary. He was talking about risk, or biography, I guess. He said, if you take a 10% chance of failure and do it once every 50 years, it's a 99.5% chance of you failing. And that's just a mathematical statistic, 99.5. And that's 10% odds. And so that's kind of how he was looking at it. I think it was really, it almost compounds like the chance of happening.
Yeah. If you are doing deals with 25% risk, that 99% probably drops to 10 years, right?
Yeah.
And I mean, I've had little deals. I flipped houses. You try a lot of stuff, but I've had a few deals that haven't made money, but they've never, because if you get in the game, you're going to have some losses. You're not going to win every time, but the key is the losses have to be manageable so you don't get wiped out. And the way I kind of talk about it is I kind of go for the line drive base hit than the grand slam. I've never done any development. I know people can hit big on development, but for me, it's just not what I want to do. Like for me, I think the way I think about investing is you put the capital to work. Yes, you have to oversee it and be smart about how you operate, but by and large, that money is working for you. And if you put them in good long-term investments, that's what happened. You kind of got to manage, monitor, keep an eye on things. But by and large, it's almost on autopilot because you're in the right markets, you've structured the deal properly. Time, population growth, and inflation is going to win the day. And again, you got to have a 5-10 year time perspective. And honestly, I've been doing it a long time. If you were to ask people, did they ever regret buying real estate? One, you're not going to find too many, but if you do find anybody, they bought at exactly the wrong time in the last 50 years, and they did it in exactly the wrong way, which typically involves being over leveraged, no cash reserves, and then they get in a jam and the market turns. Other than that, over a 10-year period, it's pretty foolproof.
Yes.
Yeah. Okay, good. Yeah. Yeah. So do you have any specific questions about me, about the market, what we can do to move forward and stuff like that?
I don't think anything specific. If you want to put me on your email list, that'd be great.
Be glad to.
That's kind of my process right now. I'm going through all the podcasts, all the stuff, and then just following up with people.
Okay.
You know, as many
Okay.
lists as possible.
Yeah, that would be great. So can I ask, how old are you?
26.
Okay. Darn, that's pretty good. I think if I remember back, I bought my first house at the age of 26. I can still
Yeah.
remember. So that's that. And actually what I'm kind of on now, I'll just kind of run it by you. As you probably know, the price on a lot of this multifamily stuff, 50, 40-year-old stuff, 70s, 80s build, it's still pretty darn expensive, right?
Yes.
And so like in Greenville, you could buy Class C units for 125 a door. Okay, just as a round number, just as a benchmark.
Mhm.
And then typically you got a plan to probably put 15 in them to do it. I mean, $7,000 is just sort of a cosmetic turn. You know, if you really want to make the unit nice, you're probably looking more 10 to 15. And I think there are a lot of builders that have a lot of inventory. You know, some guy who maybe started a 100-unit townhouse complex back 18 months ago when interest rates were 4. And now they're kind of in the middle of it. It's too late. They've already started. They can't not build. They cannot complete it. And so I'm trying to go after builders to see if they'll sell me some of their inventory in bulk at some kind of a discount. The idea being, if they can sell 50 of their townhomes, even at a 10% discount, 15% discount, and they can get them all sold in 60 days, at the end of the day, that's going to work out better for them than if it takes them 6 months or a year to sell those 50. And, you know, I'm kind of targeting here, like 175, 200 a door is about what you're going to have to pay for 12, 13, 1,400 square foot townhouse. And, you know, the rents may not quite meet the 1% rule, but you might pay 180 for something that rents for 1,500. You can make the numbers work. Not a lot of cash flow out of the gate, but theoretically, from a longer term hold perspective, it should do pretty well because you should be able to bump those rents pretty good and not have much on the repair expense. So that's kind of what I'm tracking down now. I keep looking at the older stuff, but they want 125 a door for something that's 80% occupied,
Mhm.
where the average rent is $850. Now, you might have been able to get away with that when debt was 4,
Yeah.
or you might have been able to get away because in our last couple years, basically every time on renewal, we didn't even have to do anything. We could raise the rents 5, 10%, if not more. And if you renovate them, you could even bump them more. And I think that's going to tamp down a little bit. So when you're looking at deals, if they're projecting really healthy rent bumps, I'd be a little skeptical. 2 years from now, it may be different. Like, and so on our properties, typically when we've renovated a unit, every time we renovate a unit, we set a new maximum rent in the building. Okay, right? Rented something in March for $950. In June, we got 1,000. In October, we got 1,050, and we kept ratcheting it up every time.
Yes.
We've now made the decision, no, we're going to not try to push the ceiling and rather just try to maintain occupancy. You know, we've got some good bumps here, and we still have older tenants that are at the lower level, and we're going to continue to keep trying to bump them up. But the ceiling, we're going to leave fixed and just try to maintain occupancy.
Yeah.
And you know, maybe in a year or so, the worm will turn again, and healthier rent jumps may be available. So that's kind of what we're looking at here. I wouldn't say Greenville's a real cash flow market. If I brought you a deal, if we could get you 5% average cash on cash over a 5-year period, that's probably about where it's going to be. Could be better, but I don't want to promise that. And we're still targeting, kind of wanting to get to 14 IRR. I think the days of 18 easy out of the box are not going to happen. So I think you just, as an investor, just have to adjust. And the truth is, Warren Buffett would love to get 14% IRR.
Yeah. Especially something stable. And if you got the cash reserves.
Yep.
And also you don't know the cash reserves on those developers you're talking about.
Correct.
You don't know what position. I mean, interest is
big. Yeah, so I was talking to D.R. Horton, and here in the upstate, which is 9 counties kind of in the northwest part of the state, and D.R. Horton publicly traded, pretty big. I think the guy told me they have 500 homes that are built in the upstate, and figure minimum they're at 200. The average is probably more like 275, 300. But even at 200, they've got 100 million of inventory sitting there. So anyway, it's an interesting time, and so I'm kind of considering any kind of options. But yeah, love to show you a deal. We could talk more specific, and
awesome.
would love to have you invest with us.
Yeah. Well, thanks for taking the time, Arn.
Okay, great.
Yeah, that was fun.
Okay, I'll be in touch. I'll put you on my list. I won't be spamming you, but I'll put you on the list. And if you see something that looks decent, holler. And or if you're looking at something else and you just want my 2 cents, reach out. I'll be glad to give you my opinion.
Excellent.
Okay, thanks, buddy.
Okay. Yeah.
See you later. Yep. Bye-bye.